Why worry about the Fed? You should think risk. That's the opinion of David Waddell at Waddell Associates, CEO and president there. Good to see you in New York for a change.
Yes, nice to be here. Thank you.
So we know the Fed is in the midst of a two-day meeting. Markets are banking there won't be a move, and you agree that interest rates will sit tight for a while.
Yeah, I think the only way the Fed could actually raise rates is if they determined a way to do it without impacting the dollar. And as long as a move by the Fed takes the potential for another dollar rally into account, they won't do it, because that's what haunts them from the taper tantrum. So
I guess the question will be, do markets get through this meeting and start worrying about December, or do investors look around and decide, hey, let's add risk to the portfolio?
I think the intermediate term bonds bottomed post-Brexit, right? And we all sort of recognize that those rates were rising about 2 weeks ago, but they've actually been slowly rising for months. And now we're looking for narratives to sort of explain that rise. Is the Bank of Japan out of bullets? Is the ECB out of bullets? Is the Fed going to raise? The reality is we're probably just in a range, right? We started the year at 227 on the 10-year. We got down to 130 or whatever it was, and we're probably just recapturing the midpoint of that range. So my guess is, there's some volatility for traders to play with, but for investors, we're still in this long cycle. Interest rates are probably going to stay low. The market could go up, I think, pretty substantially based upon earnings growth next year, which we hadn't seen in a year and a half. And also, if rates stay low, you can have valuations rise. So you get higher earnings, higher valuations. There's a lot of skepticism on the street. I mean, it's amazing how much skepticism there is. That's a contrarian indicator. So I think it's probably more status quo from central banks than people are considering possible right now.
But you raise a good point about earnings, because there have been so many disappointments, and the market really doesn't seem like it's doing that forward-looking thing that it's supposed to do.
Not at all, because we're navel-gazing about the Fed.
We are. And when you say the market could go up significantly, can you define that with a number?
Well, so if you look at the pattern, right, you have an early market advance, which we had, then you have a sideways period of digestion, it's Dow theory, and then at the end, you get this sort of surge of euphoria, right? Well, what would require, or what would create a surge in euphoria? Low expectations, earnings growth, the potential for valuations to rise. To me, that would signal the potential for the end of the cycle, right? Which sometimes could be a year in our elongated cycles that we're in. Maybe that's 2 years, maybe 3 years. But this cycle is not going to end until we have a bout of euphoria that's addressed, and over-addressed, I should say, by the Fed. The cycle will end traditionally, I think so. So the people that think we're going to go in recession right now, tell me why it would be so terrible, right? It'd be like 2000 to 2002, where, yeah, technically we were in a recession, but it really didn't matter.
Right.
I mean, there aren't a lot of excesses in the economy. There are not really a lot of excesses in the market, I don't think. So therefore, there should be another surge before we call it quits in this cycle.
So what about sectors, technology, for instance? We have seen some technology stocks move up to 52-week highs recently.
Right, and they should, right? Because they've been neglected while utilities ran up to historic highs. So if the intermediate part of the curve is going to rise, then that makes all of the duration risk assets that have been working, the low vol, the dividend payers, the real estate, the utilities, the telecom, and they should stop working. And what hasn't been working, which is small caps and emerging markets and tech and growth and the international, should start running. And that's exactly what's happened since the end of Brexit. So I think that's where the potential is. So for us, at least, and we're balanced in our views, but I'd weight more heavily towards beta rather than towards low vol.
What is the biggest risk, do you think, right now to the markets if it's not the Fed, if it's not really the cycle?
A total policy mistake, right? That they're stuck in their textbook world where if the unemployment rate goes below 5% because of the Phillips curve, we have to raise interest rates. I will remind you that the unemployment rate in Japan is 3%, and there's no inflation to speak of. So I think we're in a post-textbook environment. If they apply their textbook fundamentals to policy, that could lead to a mistake.
David Waddell, it's been great speaking with you. Thank you.
Nice to be here. Thank you.
I'm Rhonda Schaffler for The Street.